All right. Welcome, everyone, to Value Investing Live. I am pleased to introduce our guest this week, Kevin Silverman, the Chief Investment Officer and Portfolio Manager of Sterling Partners Equity Advisors. Thank you, everyone out there in the audience, for joining us today. And as always, please let us know where you're viewing from. Say hi out in the chat. We always do appreciate seeing those international audience members, and we love seeing where you're all from. As always, please feel free to post those questions and comments throughout the presentation. Do keep in mind we are going to go through that presentation, and then we'll go ahead and jump into all those once we get to the Q&A at the end of things today. As that is all from me, I'll go ahead and hand things over to Kevin, and we can go ahead and jump into the presentation today.
All right. Well, thank you very much, Graham. My name is Kevin Silverman. I am the Chief Investment Officer at Sterling Partners Equity Advisors. And we haven't done this before. So as I'm thinking about what to title this, we've come up with Small Cap Value Portfolio Management 101, how to become one, and then what to do after that. And then we'll have two stock ideas as well at the end, and then, as Graham says, some Q&A. Before we get to that, though, I'd just like to do a little advertisement for my firm. We've got a really great little firm. We're experts at small cap value investing. We've got a 20-year track record, and as you see here, we've gone to the trouble of even putting the title page on here, Guru Focus Value Investing Live. So let me just walk through this very quickly. Little disclaimer here, which you can screenshot and read at your leisure later. And then here's what we do. This is what I've always wanted to do, and I'm just thrilled I get to do it. We run two small cap strategies, long only, a 60 stock and a 30 stock. We run it as one big portfolio, but then we take our best ideas and we put them into the concentrated portfolio because some people prefer that. Sometimes you get a little better Sharpe ratio with one or the other. Sometimes people don't want your second best ideas in their portfolio. So we have two flavors of that. We've been doing this about 20 years. We've got a great team, and of course, Sterling Partners, doing business as Sterling Fund Management, is our parent and our affiliate. This is something we're very proud of on the team. We've just recently won an award for Manager of the Decade, which I guess 10 people win. But we're most proud of our risk metrics. We've had lower standard deviation than the bench while outperforming. And we also have a beta of 1 relative to our bench, which is the Russell 2000 value. And so, that's something we've worked hard at. We're very proud of it. We're in Chicago. We're active managers. We've been doing this a long time. There's 48 employees at Sterling Partners, and the firm has about $1.7 billion of management under management in private equity and 21 portfolio companies to round out the team. This is our long only small cap team. So that's an older picture of me. It's my COVID beard here. Jason Ryder's been on the team a very long time. Joined in 2005, just a tremendous right-hand man and steeped in value. You can see some of the stats there. Nathan Schmidt joined us 5 years ago, came out of the Creighton School, just a very capable young analyst who really digs into the quantitative side and also does a lot of our modeling. Tim Knight joined us recently from Grosvenor, and he's had some other deep experience in the business. And we're your team. So if you have a friend that needs small cap value, this is us. We adhere to a disciplined, repeatable investment process, which, by the way, all value investors are going to tell you. We remove our emotion. Trust your instruments. Trust your models. I'm going to talk about that a little later in terms of the art of the craft and all that. We like to get a big discount to what we call true worth or intrinsic value. We'll talk about that. And sometimes the best thing to do is nothing. And patience is sometimes a good way to earn excess return. We have two flavors, as I said. This is a little bit about each one. Basically, the larger portfolio, we have smaller weights at the beginning. The concentrated, we have bigger weights. Again, you can look at that at your leisure. And I can tell you, we didn't do this specially for this. This is actually a window into our institutional presentation. So please pass it along. And that's the end of it. So let me leave you with this on the screen, since it's so nice. And let's get to the talk, how to become a small cap value manager, and then what to do after that, right? That's really the key. So let me jump in. What do you do? Well, first, you've got to be a curious kid to start. You got to like puzzles. You got to like sports. You have to enjoy debate, persuasive arguments without getting people mad. And also another sign is that you got a lot of friends, that you're a social person. So make sure you're like that, and then go to college right away. Now, in my case, I went to UW-Madison. I joined a program called the Applied Security Analysis Program. They have an amazing legacy, all started by Professor Steve Hawk, who I consider a friend, and he guided so many hundreds of students into our industry. The key lessons from the University of Wisconsin for me and our business: how to value a business. That's what matters to doing this. If you can't do that, you're not going to pick stocks very well. So, and we'll get into how to do that, but that was the key lesson from business school: how to forecast the economy. That's important. A lot of value investors say they're bottom up, but you got to forecast revenues, and that usually ties into the economy. How to forecast revenues, cash flows, these are all critical skills. The one thing school doesn't teach you very well, in my opinion, is how to sell, because these are products ultimately. We're not academics trying to get an A. I mean, we want to get an A, but ultimately we need to sell these products. And business school, I think, may be doing a better job of that, but that's an important element to try to learn off campus somewhere, maybe get a job selling something somewhere. And you need to enjoy persuading and making good arguments. That's really the core of this. My whole career was in Chicago. Chicago's a great investing town. And I started at Duff & Phelps writing long reports. You have to learn how to communicate, and that gives you a sense of what are the drivers of a company's valuation. A funny story out of that when I was a young analyst was simply that I was covering a company called PPG Industries, a big glass company. And a guy called me up and he said, hey, the stock's plummeting. What's going on? And of course, I'm a young analyst. I know what to do. So I get the 10Q out and I just start reading. And it's like, well, they're investing in some oil and gas assets. Maybe that's not working. This is in the 10Q. The guy just starts yelling at me like I'm an idiot. And I was. Obviously, something was happening that day. So there's definitely a learning curve to our business. And I'd say writing reports to convey information and sentiment to an investor group, for me, was a good way to start. After that, though, I got a little interested in understanding where the market was, the stock market. Where is it? It's not on a desk writing reports. I figured out it's in the capital markets of Wall Street. The bankers, the salespeople, the traders, the research team. That's where earnings are kind of thought about, and also sentiment, PE. There's two components to this thing, E and PE. And buy side is not that steeped in PE, where PE is happening. Excuse me, is on capital markets desk. So I joined Stifel Nicholas, big firm now. It was small then. But you have a license to talk to all the investors, all the competitors, all the CEOs. It's a wonderful cauldron of education to get on the sell side. And I always recommend that to students when they come out. Spend a little time there. Once I got my arms around that, I was recruited to a great firm called Harris Associates, one of the benchmark value shops really in the world, in my opinion. The dedication to equity research was simply inspiring at that firm. And you had some really legendary guys like Ralph Wanger and Roger Brown and Myron Gold, who created a culture there of excellence around research. And a lot of the lessons there, I'm still putting to use today, and they're good lessons. They had, I'll tell a story from there. This is a long time ago, but they were so dedicated to getting to the heart of the matter that they had a guy that sat in a back room. He rarely came out, and he was grizzled. He always had a cigar. It was always lit. You could smoke in your office then. And he had all these secret maps I'd say, hey, what's that? He's like, don't look at that. It's a secret map that tells where all the palladium mines are or something. So this was such a craft back in those days of digging through, finding information. And that's really the key to value investing. Do the research, find out what other people don't know, shrink the bell curve around your estimates. And those guys were geniuses at that. But still, I'm saying that now. At that time, everyone there was saying how smart we all were, but I started to think that it was like your mom saying you're smart. Oh, really? Oh, so I wanted to go out into the marketplace and find out what other people thought and really sharpen the saw. So I went back to the sell side. And again, I highly recommend this if you want to do this job. And the key is go pitch an idea to the smartest PMs you can meet. Your sales team will take you in. And then step 2, get the crap beat out of you day after day. Step 3, heal your wounds and then go back into battle, improve your pitch. And after a number of years, you're going to start to figure out, what the market's interested in, what they're not. What's happening today in the stock is actually not in the 10Q, as I learned later on. The key is there's a mosaic. And one of the reasons active management, at least in small cap, is going to stay alive and well is there's a mosaic and, I guess call it factors if you want. But the computers, they have stable factors that they look back in time and try to model. The thing about stock prices is they're based on things that haven't happened. It's in the future. And the future is not in the numbers. And the computers, they don't think about the future. They just think about these numbers. So when things are changing, when paradigms are changing, when factor weights are changing, the computers lose. When new products are being invented that aren't in the databases, computers lose. So active management's alive and well. It's in small cap. And bear in mind, Wall Street puts fewer resources to small cap because the companies are smaller. There's not as much economics. Young analysts coming right out of school, where do they put them? On the small companies that don't have as much economics. So in effect, doing small cap, you are in a position to study products because they matter. And you're competing with younger analysts who, quite honestly, still get scared when salesmen start yelling at them. So you have to overcome that. And I think for me anyway, I started to learn that by being on the sell side. Once I really felt that I had those skills, I really wanted to go back to the buy side and do this. So how to become it? Prepare. Everything I just said is about preparing, sharpen the saw, go to the sell side, talk to all the smart people, how they do it. And it's a mosaic. You'll slowly come to your own approach. Now, at the point in time when I thought I had enough skills to maybe think I could do this, which of course you still don't, but you're brave enough to go do it. I basically, and this is advice, you don't know if someone is going to anoint you a portfolio manager. You hope so, but let's say that's what you want to do. You want to wait for someone to anoint you. What I did was I took a bonus check. I made sure I was fired from my job. At one point, ABN AMRO went broke. They fired 500 people. I made sure I didn't work anywhere. I took a check. I wrote it to my own LLC, and that LLC opened an account at a brokerage firm, happened to be Morgan Stanley. And then I started running that as an institutional portfolio, even though it was small. Sector weights, cash balances, turnover, all of a sudden, just start managing it like it has $500 million. And then that is a GIPS compliant track record. And that's what we're selling right now. That's the data I just showed you in this chart. I started it with my own money 20 years ago, and now it's an institutional product. So that's advice. If you want to do it yourself. Don't wait around. Once I anointed myself a PM, then I was able to join in with a little startup registered investment advisor, which my old boss from Harris Associates had started. So I couldn't have been more thrilled. He and I started this little firm to bring institutional small cap value to his family, certainly, but also institutional customers. And I started doing what I'm doing now. At some point, about 7 years ago, he died. And I brought the team to Sterling Partners. Sterling Partners is a 30-year private equity firm in Chicago, very successful middle market firm. They've got about $1.7 billion under management. I think 21 portfolio companies. And we're not a portfolio company, we're an affiliate, and we share the compliance officer, the CFO, and of course, our chairman is their chairman. So we're tucked into this wonderful institutional quality private equity firm, and it's been a wonderful experience. We joined there about 5 years ago. So that is phase one of my talk, how to become a small cap value manager. Okay, I mean, everyone does it a little differently, but I tried to just prepare by going in front of the smartest people in our business, getting the crap beat out of me for not knowing what I was doing. That took about 10 or 15 years to hone the skill set. And then I started a little firm, joined it into Sterling Partners. So that's step one. Now what? Okay, so you're a portfolio manager. Now what? You just saw that we've had very good numbers. Is that all luck? I thought so for a long time, but my stats side started saying, no, that's a statistically significant alpha generating track record with less volatility than the market. So I had to start thinking, well, maybe we do know something about how to do this. So let's write it down. So step one, philosophy. This is the secret sauce. So if you haven't been taking notes, here's the time, okay? Philosophy. Stocks get mispriced. They get mispriced a lot. I mean, I hear all the time, how can you buy a stock when the market's expensive? First of all, tops always look expensive. So it looked expensive at one point in the 50s and the 60s and the 70s. It always looks expensive as it keeps going up for decades. So that doesn't quite concern me. Also, when stocks report earnings and they miss the number, and the analysts all have to talk about what happened, how often do you think analysts get these numbers wrong? A lot. I'd say half the time, or in the best of cases, a third of the time. So when analysts miss the number, now stocks generally are going down. Sometimes they go down a lot. Now, at that point, in my opinion, there's an opportunity that a misperception has just occurred. And that's the stuff to chase. Earnings come out, stocks go down. Is it mispriced? Half the time it is. So at that point, I would say the best thing to do is make an intrinsic value estimate. For us, that's always step one. Get an intrinsic value estimate. How do you value the company is step two, but you need that estimate. So we use a bunch of different models. Obviously, the present value of cash flows. John Burr Williams, kind of discovered that. I won't say invented, but discovered. Ben Graham, intrinsic value, the true worth of it. And there's a number there, and there's a bell curve around. So what we do is we make an estimate, and then our entire research process is making that estimate better, shrinking, if you will, the bell curve around our estimate, and try to make a reliable estimate. And then rely on it. So we calculate expected return to that number, and it's just that simple. If you had a research team that could just tell you what stock prices are going to be 4 years from now, you wouldn't need a lot of research. But that's the goal of our research, is to find out what those stocks are going to be worth 4 years from now. And our research drives our models. So we have very detailed 10-year models that express our research about what's happening. Prices, market share, units times price, of course, revenue, costs, tax rate, debt, the whole thing, balance sheets. We do quarterly numbers. And we also have a revenue model that ties into some sector of the economy. Again, value investors sometimes say we're bottom up, but then I say, well, how do you get your revenue estimate? Because you got to tie into the economy. We start with GDP and then sectors, and then our companies have products, and they certainly can't grow in total faster than the sectors. So, by the way, investment bankers they sometimes don't realize that. Their clients, they think, in total can get bigger than the industry. That's where I first learned models were important. And long-term models is when bankers are estimating their companies are going to eventually 8 years from now be bigger than the industry. So just like a pilot flying into a cloud, you got to trust your instruments. We're all humans. We're all going to have emotions. We're all uncertain. That's why we have instruments, and that's why we trust them, and we try to build the best models we can to predict intrinsic value. What we found is that these misperceptions around earnings create a ton of wonderful opportunity. First, when earnings are down and people are confused, guess what's also down? The multiple, the cash flow multiple, whatever multiple you like. It's also down. So when earnings are down and people are unhappy, the perception, the sentiment is down. So I like to think about something called the square root of 2. And what is that? Well, we like to get a stock that doubles in 4 years. That's north of 20% compound return. And that's certainly acceptable to any investor, any institutional investor. That's what we shoot for. How do you get to that? It's easy if you break it down. You basically need a stock that earnings are going to go up, 40%. So 1.41 square root of 2. They go up 40%. And let's say that takes 4 years. Okay. So earnings go from $1 to $1.40. And now you got the PE. When things are misperceived, the PE is a 10. Okay. If it goes up 40%, that's 14. So 10 times 1 is 10. 140 times 14 is 20. That's a double. So it really, when you break it down into its components, earnings, that's just 10% a year, basically. Can you find a stock that earnings can go up to 10% a year when people don't think they will? Yes, you can. Can you find a stock where the PE is 40% below where it's going to be 4 years from now because the company's going to beat perceptions? Yes, you can. And so that's what we try to do. It's break it down. It's simple. And so our models make sure we're on track. Obviously, if people aren't hitting their milestones, not every stock does what you want. You got to know that. But we have models that get us out past the point of emotional healing. I don't know how many of you might have seen that book about the 7 stages of grieving. One of the things spending a lot of time in capital markets does is it teaches you that that's going on with stocks too. When companies disappoint or they miss numbers or they screw up, the whole capital markets, the traders, the analysts that cover them, the PMs that traditionally bought them, the bankers that banked them, they all kind of get a bad feeling, like a death, that this company disappointed them. I lived through it. It happens. And so when that happens, you get a lot of time to do your homework. You don't have any sunk cost in this thing. You're not grieving, but it gives you time to look at companies when all the traditionally interested parties are just mad. They're mad at it. And it's funny, but it's one of those funny things on Wall Street where human emotion gets in the way, particularly with younger analysts, smaller companies, and you can get in and do your homework. This is why I like 4-year models. Our turnover in our portfolio is, and again, this is one of those things that takes you 20 years to come to realize, our turnover is the same as our horizon. So that gives me a lot of confidence about our horizon. When you look out 4 years, okay, year 1 on a recovery, people still don't believe it. Year 2, maybe. Year 3, people start to believe it. Now the multiple starts to rise. And by year 4, you might very well have an overvalued stock, and then you're going to sell it to the growth investors. So that's a little bit of the secret sauce. Earnings really have great models, but then price earnings, or my favorite multiple is really enterprise value to EBITDA. I flip it around. EBITDA over enterprise value is a cash on cash yield. One of the reasons we fit so well with Sterling Partners, private equity firm, is we look at companies as if they're private companies. Cash flow yields are the anchor to valuation in my mind, particularly when the world is awash in money. Why are interest rates so low and everyone's so worried about inflation? How can that be so? Guess what? We have more money than we need. That's why it's cheap. So 10-year models, that's the key. Trust your instruments, rely on those models, rely on your analysts. Democracy of thought. I used to go into firms where the leader would just talk and then one person would talk, the expert on that subject, and all the other people around the table were silent. It made no sense. Dissonance is information. You have knowledge, dissonance, information. It's information you can benefit from. And also the thing to remember is long meetings and pontificating, everyone talking, it takes time. And this information has time value. As you're talking, and guess what? My team isn't. We've decided we're buying it. You're talking stocks, the value of what you know erodes very quickly in our space. The other thing I'd throw out is as you're thinking about ways to get pools of stocks to go through, where do you start? I think cash flow yield is a wonderful place to start. Stocks that are down have a higher cash flow yield. If they're down and they're still generating cash, maybe there's a misperception, and that's a place to start, in my opinion. Also, good balance sheets. Value investors, as you just heard me say, you need 4 years to wait. So you better have a balance sheet that can get you there. If you can't get to year 4, you're not going to earn money in year 4. So you got to watch out for that. Also, wind at your back. There's so much that we don't know. One of the things I've always been a student of that's helped us is the consumer expenditure study. You know, they know what people buy at each age. So I've been a student of this for years. Demographics, the baby boom, you know, you always knew what those people were going to buy: healthcare, leisure, productivity, software, things with incremental margins of 100%, companies that have patents. You know, Morningstar made moats famous. Well, I don't know, you know, they've been around before that. Competitive advantages, you know, Porter. So get companies that are great, buy them when there's a misunderstanding, and then I think you're going to have very good results. So I don't know how much time I've used up, but there we have first how to prepare to become a small cap value manager, and then how to be a small cap value manager. And now you've learned all my secret sauce. I probably don't even have to do this anymore now. Okay, so the big finish. We've got 2 stock ideas. And I just, for my compliance officer that's probably listening in, we own these now. We're not adding to them right now at all. But these are great companies, in my opinion. The first one is Patrick Industries, PATK, $81. This is one of the themes we have in leisure. So you might say, how do I pick which leisure stock I should own? A boat company, an RV company, and I don't know. These guys make materials for all of those. They make cabinets and all the hardware and such for boats, RVs, things like that. So with one-stop shopping, you get a guy that's supplying leisure vehicles, and that's an industry that's gaining a lot of share. And we've owned this a long time. It worked well in 2020, but it's still 9 times EBITDA. They're doing accretive acquisitions. I think there's really a roll-up in the industry. They're going to begin supplying, I think, modular homes with you know, cabinetry and things like that. So this is a company that is, I think, going to be good for a long time. This is a theme that's working. The industry's consolidating, and I'd take a look at this PATK. The key is it's got a 15% cash-on-cash yield, and they've grown about 6-7% a year organically, and then they're buying 5 or 8 or 10% growth every year. So that's a quick overview, but go do your own homework on that. Patrick Industries. I think that's a good long-term hold. And then this other one is a little more hair on it, I'd say. But it's the kind of thing a value investor needs to go look at. And of course, I might be wrong on it. I just bought it. It's called Atlas Technical Consultants, ATCX. It's one of these poof, it's a company. It's a SPAC. So SPACs got some bad press recently around the accounting. We've done a lot of homework on that. And by the way, all the accounting around this stuff is non-cash. So even if you're worried about it, it's a non-cash function. These guys cleaned up all their warrants and all their options and all that a few months ago. But what they did was they bought an inspection company. So whenever there's a giant infrastructure program, an inspector has to come, make sure it meets all the criteria before they get paid. These were regional companies that would come into regional projects. So Atlas was purchased through a reverse merger with a SPAC. They took out all the bad, warrants, high cost debt. It's a very clean company now, just as of a month and a half ago. They haven't even printed a 10K yet with all these moving parts not moving. At the core, it's going to be a roll-up of regional inspection companies. The board is filled with senior engineers of companies that build roads and bridges and tunnels. And it is a bit of an infrastructure play, but I would also say the bigger play is safety and cash flows, safety and growth. It's going to grow with GDP. Infrastructure could get a bump, but even if it doesn't, it's a GDP grower and it's very stable. Maintenance and things like that tend to be more stable. The company right now is perceived to be high debt, and people think that's dangerous. But the cash flows are so secure that it's the type of balance sheet and company that can stand the debt. In fact, the debt is helping equity holders get a better return because of the stability of it. And I think what we're going to see over the next 2 years is some nice, stable growth that removes the what people think is too high of a debt ratio right now. Debt to EBITDA, I think at the moment is in the 5 range, which scares people. But with investments they've already made, about 12 months from now, it'll be around 3. So very stable infrastructure company. But at the core, you've got a misunderstanding around the balance sheet and a misunderstanding, I think, a bit around SPACs, which are giving you an entry point here. And I would take advantage of it. It's 9 times EBITDA. That's an 11% cash on cash yield. And then I think it grows 7% between organic and acquisitions. That gets me up around 18 to 20% cash on cash total return, or I should say total return cash on cash plus growth. And that's very attractive to us. So Atlas, ATCX, and there you have it, Graham, all set.
All righty. Well, thank you so much, Kevin, for walking us through that wonderful presentation, taking us on a journey there, giving away a couple of those secrets to the trade. Hopefully nobody out here in the audience will be coming for your job, but they generally seem like some pretty stand-up people, so I wouldn't be too worried about it. We do have some questions built up, though. Granted, we kind of already answered this first one, but we'll go ahead and put it into relatively simple terms now. A question coming from Richard here asking, as an individual value investor, how should we select stocks to buy?
Well, I think that the key thing is you don't want them to go to zero. That would be step one. So make sure you have a good balance sheet. If you want to take a ton of risk, I think that's maybe what the options market is for. I've never been one to buy a stock as an option. So I like a good balance sheet. And then I like a little misunderstanding that I understand why I, know the stock's going to do better where the market doesn't. So I want to understand what it is that the market doesn't like. So I start with these cash flow screens. I think Y charts I use with Morningstar. I think Yahoo has a simple screen. It's a craft. So I'd start with enterprise value to revenue. Keep that number low. Don't screen out money-losing companies because, again, that leads to less demand now. And then when they make money again, demand comes in. You got to remember what makes stock prices really go up is demand. Supply is stable, the share count generally. And so demand comes in when things are going well, demand goes out when they're not going well. So I think if you can start with a good enterprise value to sales with an earnings margin that you think can improve over the next few years, and you understand why you believe that and the market does not, and you have a good balance sheet, that's money in the bank right there.
Absolutely. And continuing on, looks like we have a little bit of sentiment from people. They didn't learn too much at business school here, didn't get rich following academics. Continuing from there, one person out here in the chat wondering what your suggestion is if they're finding market valuation is high and under PE of the market with expected growth. Do they wait for a market correction or forget this general market valuation? It seems like most of your recommendations have been leaning more towards the latter there and finding some good options out there.
Well, I first would say that the academic research is you can't market time. I think people in our industry try to sell that to people. There's a lot of fear about what if the market goes down, maybe I should wait. But there's an interesting stat about mutual fund investors where mutual funds earn 10% on average a year, but mutual fund investors earn 6% on average a year. Why is that? Well, they buy and sell at the wrong time. So as an individual investor, if you think you should buy it, just take a pause and think, is that groupthink? Or is it contrarian thinking? I mean, at a simple level, contrarian works because there's more demand on that side and when it swings back. So think you want to be an investor at the side of the pool where the water isn't, and then when the water tilts, you're in the water. So again, look around. If everyone thinks what you think, that's not a good idea. I think you got to find a position where you have a unique, differentiated view, and it's supported by facts that you've done through your research. For me, that's typically about market share. And the easiest mistake analysts make is they think a company can't recover. They've just missed earnings. But you get in and they're a low-cost producer. How can they not recover? People are going to come back and buy the low-cost product. Or they've got the best feature. People have to buy that. Or they have a patent that people have to buy. So I think you've got to build some conviction around earnings and understand why you believe that and the market doesn't. And then be right. That's also important.
Definitely. And continuing on, another question here that we have, one that I've said I think has come up a lot, and I don't know that there is necessarily a right or wrong answer here, but we are looking to get your opinion on it here, and that would be, in your view, from our audience member here, will value overtake growth if deflation or stagflation hits the economy? Why or why not? What's your stance there?
Well, value versus growth is a very interesting conversation in general. You know, when they started these indices, they were, I think, 75% correlated. So they were kind of different. Now, the Russell Value and Growth indices, if you correlate monthly returns, they're 96% correlated. It's almost becoming a difference that doesn't matter. Like U.S. equities are more correlated than U.S. equities versus, foreign bonds. There's other asset classes that are truly distinct. Value and growth is a giant business for the Russell Company, and so it kind of persists because there's $1 trillion in it in terms of indices and things like that. So having said that as a backdrop, these are, I think, increasingly phony categories. It used to be based on book value, price to book. So think about it. Price to book, if it's low, that might be a good value. If book is really the value and price is below book, that seems simple. But if price is above book, is it a growth stock or is it an overvalued stock? So value and growth to me are, you could get both. I like both. I like things that grow faster than the economy because they're gaining share, and their value because the market is not understanding that right now. And when can that happen? When there's a miss. So that's what I think. But to get to your question, value stocks in general are going to do better than growth, I think, during rising interest rate periods. Because if you think about the logic, growth companies, two companies at the same time, growth and value, right? The growth guy is going to have higher earnings in the out years. And when rates go up, those out years are discounted to a lower number now. So we've just come through a decade of falling interest rates. Growth beat value because those out years became more valuable. Also, in the value index, there's more financials, banks, insurance companies, and that's the one eddy of the market where book value is still trying to be the actual liquid value. So on a price to book basis, those go in there. And during a falling interest rate environment, banks don't make as much money. So part of the problem with the value index, particularly the small cap, is it's overweighted in financials, which systemically do poorly in falling interest rate environments. So are they going to do better in the future? If you think rates are going up and inflation is coming, which there's a decent argument for that, I mean, who knows? But if we get more inflation and higher rates, then yes, value will almost certainly outperform. And if you go look at the Ken French, Eugene Fama study from 1928, Ken French keeps this on his site at the Tuck Business School. Value, small cap value, has been outperforming since 1928. They keep all the data. And it did have a 10-year period of underperforming, but it's just a blip over that whole period. And I think the reason is that value stocks, you're buying them when they're misunderstood. Small cap, particularly, not a lot of people, are looking at them. And to me, that's the opportunity for the biggest return. And they're perceived as riskier, so they deliver a higher return. But in my opinion, they're not at all, because you can study the products and see how those are doing versus a large cap where it's sort of hard to figure out which array of products are really moving the needle. So I think growth has had its day in terms of the last decade, and the future 10 years will be, I think, the period for small cap value.
Well, there you go, audience. Looks like value is where we're looking for the future. Not that we aren't all value investors here to begin with, but hear it from Kevin himself here, value's where it's at. Continuing on, and you hit on this real briefly, or I guess hinted at it a little bit, but looking out from the U.S. here, question from the audience asking, what's your feeling about the so-called ADR structure? Chinese companies looking attractive, for example, Alibaba here, but this audience member thinks that their ADR structure is less than appealing.
Well, there's all kinds of investors, and of course, the global asset allocation might include some Chinese stocks. But in my own experience, I simply don't trust the Chinese accounting. Just going to be honest about it. I took a lot of meetings with Chinese companies for a decade to understand what they were talking about and what they were doing. I don't believe they let American auditors into their financial statements or into their headquarters. I think that the data is suspect, at least for me. I'm not going over there to study it. And so I'm a U.S. equity guy entirely. The other thing I would say is the wealth of the world is in Western nations. And the United States, despite all that's going on, it's really never been a safer time in history or a richer time in history. And I think what's happened, particularly with the S&P 500, is that U.S. equities are becoming the treasury bonds of rich world equity investors. It's the safest equity markets. You got to ask yourself, why is our interest rate structure higher than other places? And at the same time, our stock market is outperforming. We've got higher rates and better equities. How is that possible? Well, there's really only one way. The risk premium is rising in other places and shrinking here because we're a safer place to have your money, in my opinion. So I don't own any Chinese stocks, although companies that buy low-cost Chinese products that are good and that helps them have a lower cost structure and win share, that's the way I benefit from China.
Understood. And it looks like we're getting some agreement there from the audience member asking that question. Relatively simple question here now for you, which I believe you did just hit on, saying that you are a U.S. equity investor. But do you hedge or short sell at all?
I don't know, because in order to be really great, in my opinion, at doing this, that's what you should be doing. We do have clients, though. We've generated such consistent alpha with lower risk than our bench that we have clients that do hedge out the Russell 2000 value and just use our strategy to eke out the alpha and then lever all that up. So, we're an alpha. I would say we're a little group that can generate alpha in small cap U.S. equities, and then people use that in a lot of different ways, but that's what we make.
Absolutely. And throwing things back all the way to the beginning of today in the presentation, audience member, his name's John here, asking what kind of structure would you use and why for starting up as a fund manager? You mentioned going into it as an LLC. Is there something else you would recommend? What do you think would be the best way of going about it?
Well, in terms of, you're a person on the street, you want to start a an RIA, to me, step one is you get an LLC. It's a corporate structure. So from an institutional point of view, when you get 20 years later, I started an LLC with like very little money, but an LLC is an institution, right? So that starts your institutional track record. And all you have to do is make sure you're pretending it's 500 million, however much you have in it. In terms of your liquidity metrics and how much you buy of different positions, you have to keep in mind that if you have 500 million under management, you take a 1% position, that's 5 million. So even if you have 100,000 or whatever you have to think about it so that it's viewed as institutional later on. You got to make sure that you're buying things that would be purchasable at a $500 million fund. So, but that's the cheapest way in, Graham. You start an LLC. A lot of states it costs $20. Now you're an institution. Now you get a checkbook. Now you can write a check to Morgan Stanley. Now you're running a fund. It's just that easy.
Well, John, there you go. If you want to make it happen, it seems like it's a relatively easy process. And if I've taken anything from Kevin today, it sounds like you should go ahead and go out and make it happen. So continuing down our list of questions here, Kevin, one that I'm going to go ahead and toss out at you here, and if we don't want to dive into it, no big deal here, but this audience member noticed a holding in your fund of Cavalco Growers, it looks like. They said they own it, and they just wanted your quick opinion on it.
Well, Calavo, as you know, they do avocados. They got very beat up in the pandemic because I think more avocado is used maybe in restaurants and such than at home. It's kind of a cumbersome fruit. It's not like biting into an apple or what have you. But in terms of the future of avocado, again, it's a silly thing to delve into. We think about market share. So avocado is gaining market share of the human, the American, meal palette, if you will. And they got very beat up through some seasonal reasons and due to the pandemic. So we own it, as you said, and I think it's very attractive here. You can't quite point at exactly when it's going to turn. When you're a value investor, again, patience is important, but it's sitting at a level where if you believe that in the future, 4 years from now, they're going to be eating more avocados than now, then it's a tremendous opportunity here. And they've got a very depressed margin right now due to some seasonal factors. So food and farm products, it's a very tricky area to invest in because these cycles can last a long time of drought or overproduction, underproduction. And so you have to be patient. But the thesis here is simply that this product is gaining share. You're buying it when there's a perception that the margin won't recover. And I'm certain that it will. So, as much certain as you can be. Obviously, if an asteroid hits the Earth, then all bets are off. But I think over a 5 or 6 year horizon, I'm going to bet I'm going to get a 20% return on this name.
All righty then. And next question now. I know we've hit on this a decent bit. I'll go ahead and narrow down this question a little bit here as well. But it is asking about any valuation metrics you look at, and I'll narrow it down to if you could pick a single favorite one, what would that be?
My favorite valuation metric is simply EBITDA divided by enterprise value. I think of that as a cash on cash yield. So if we bought the company, bought all the equity, bought all the debt, so we keep the interest, right? And then we net out any cash on their balance sheet, that's enterprise value. That's what we would have to pay to have the right to all the cash flow. So I look at EBITDA as a proxy for cash flow. Now, it's not always perfect. Sometimes D&A, depreciation and amortization, you might have to invest a lot in CapEx. So, okay, maybe you don't get the full EBITDA. But as a general place to start, to get a list of things to look at, EBITDA over enterprise value, I think of as a yield, and then a growth in the value of the company, which a good proxy for that is just long-term earnings growth expectations. Add those together, and that's a really rough estimate of total return. And that's what gets us going on a name. And then, of course, we make detailed intrinsic value estimates. And so we calculate expected return. If a stock is at 10 now, and we think it can get to 25 in 5 years based on, again, a mosaic. We use a dividend discount model. We use private market value. What are other companies paying for like assets? We look at that. We like, just a straight discounted cash flow model. And then Wall Street uses a model that's silly, but worth paying attention to because they use it, which is just the PE divided by the growth rate. I mean, it's silly, but it sometimes gives you a window into when they'll start to get interested in it. And so it's worth paying attention to. But we look at all those. I don't want model risk. Don't get caught up in one model that you always point to. It's a mosaic. The weights of these things are changing. And so, but that's a good place to start to your listener. Enterprise value, the sort of cash on cash, EBITDA over enterprise value plus growth.
Definitely. And throwing it back out to the world, obviously we've pretty well nixed China at this point, but do you have any thoughts on any of the other emerging markets out there, India, Brazil, South Africa, Russia, places like that?
I mean, I think asset allocation is the key. I mean, bear in mind, we do small cap value. We want to be your small cap value guy in the allocation you have for small cap value. So depending on, your individual situation, if I'm a global asset allocator, then all those names you just mentioned are going to have a little spot on the wheel. How much do you want in emerging markets is going to depend. Again, this isn't what we think about, but currency. Okay, America, we've had such strong currency that ultimately currency swamps these other metrics around valuations in individual countries. And I'd say 75%, and I did this homework many years ago, may not be true now, but 70 to 75% of your total return from foreign investments is the currency related to those nations. So once you know that, I don't spend a lot of time thinking about fundamental analysis of foreign stocks because it's mostly currency. Now, having said that, I do think that depending on who you are, you should have a fully allocated, asset allocation, including foreign markets, and maybe along GDP. I mean, maybe only 25% of it should be United States, and maybe Europe should be 30%. And I think that's a very prudent way to do it. And it also is mean reverting in that the U.S. has had such a strong equity market. I happen to believe it's going to continue because of what I said earlier about the risk premium. We're the safest country. You've got the president of France worried about Russian armies and things like that. So people don't want to be in Switzerland and places like that. The billionaires, they're all bringing their money here. I think that's going to continue. But if you're a mean reversion guy, then foreign investment at this point in time, it makes sense. And all the big brokerage firms are recommending a little bit of a tilt versus the U.S. because of that reason.
Understood. And interesting question here that we got in our last presentation, and feel free to go into it to the extent of your comfort level, but do you use any religion in your investing philosophy, or does that play any role in it for you?
Well, we pray to God all the time that these stocks go up, I will say. And beyond that, no, not too much.
All right. Well, relatively simple answer there for us. Continuing down, next question here. What sectors are you finding the most value in currently? Where do you think you'll do well in tapering and increasing interest rate environment?
Well, we're driven by the market. We let the market tell us where the opportunities are by the things that are offering up good cash flow yields. It's self-correct. When stocks have bad sentiment, the yield goes up to lure you in. So what that does is it lures me in to do research. And then we try to get an edge in the fundamental research. As I said, if we start to have a differentiated view about year 3 and 4 than the market, and we have an expected return, as I said earlier, that's over 20%, that's where we're going to get interested. Right at the moment, where the value is, it's a little tricky because, of course, this job really is about predicting the future. Again, the future is not in the financial statements. And none of the CEOs know the future. We're all on an equal playing field when we're trying to predict the future. So which sectors? My go-to for sectors, given that I don't know what the market's going to do, I don't know what interest rates are due, is always back to what I said earlier, consumer expenditures. What do people want to do? I start predicting that. I go to the consumer expenditures. And then I buy companies that sell products that people need. They need them. We're a civilization. So what do we need? Well, heat, food, right? Transportation, Maslow's hierarchy of needs. I'd say if you stick to that and stick to things people need, and then you have patience and the things that people need, make sure the company you're buying, they do it better than other people. They're best at it. They're gaining share. They have the best thing. That way, even if things go to hell, what happens is your company, if it's low cost, it'll gain share in a bad period. All the other companies will go out of business. It's protection. If you have the low cost boiler company, economy goes to hell, all your competitors are out of business. Is that bad? Maybe not. Then on the other side, they're gone. So, these recessions, people are fearful of them. I like them, honestly, because you have a longer term horizon, because it separates the good companies and the bad ones. The bad ones are gone, and now the good one is cheap because everyone's afraid. Well, unless history completely changes, within the next 3 or 4 years, people are going to now think better about that company. And if they're selling heaters, I'm going to guess they're going to still sell heaters. We own things where companies are doing something faster or better or cheaper than their competitors. And that keeps us on solid ground. We're not making guesses. We're not buying esoteric things because of the chart pattern or because someone says, hey, that looks interesting. I'm like, how many people are buying that? And are they going to keep buying it? And we start from there. What do people want? I think that keeps you on very solid ground. And then just buy it when, as I said, the group is over here and you have a differentiated view for reasons that you can understand. And don't be afraid to look out 2 or 3 years. The crowd isn't there, but they will be in 3 years. So I think, looking out into the future, having a differentiated view, letting the market decide, and go with the trends of what people are buying. Faster, better, cheaper is the companies that you should be looking at.
Definitely. And I'll go ahead and toss a question out here, one that we like to ask from Guru Focus here. We've hit a lot on metrics and numbers and whatnot, and you did mention CEOs in that last answer. How much would you say you weight metrics versus management? Do you lean one way or another? Does the management even play a purpose in valuations for you?
Well, I think that, first of all, CEOs are cheerleaders for their company. So I would just say, if you ask a CEO how things are going at the company, what percentage of companies do you think things aren't going well? Half? A third? Look in your own life. How much is going well, right? But every CEO you talk to, great. So I'm a little untrusting of CEOs. The data is in the financials. So I like to look at return on capital. Like, how are you doing? You say you're great, but hey, this ROI is slipping. What's going on? Or one of my favorite metrics is incremental return on capital. So you want to judge a CEO? Okay. When did he arrive? And then how much CapEx was spent since then? CEOs don't have a lot of control over too many things. They can't build a factory this year. It takes a long time. They can't change everything, but they can, veto CapEx and such. And so I like to go and judge them on how much CapEx has been spent since they came and how much has EBITDA grown since they came. Incremental numbers. And then, yes, management matters a lot. They're the ones deciding where to put the capital spending. So that's one little clue you have. Also, working capital. There's a lot of efficiency. If you can somehow get your inventories lower, that helps ROI. So I'm all about ROI. That's the metric I care about, because if I own the company, that's what I get. So that's my focus. And I judge management on that. And all my Q&A, again, one of the edges we have is a lot of years on the sell side. you're grilling management about what they want to sell their division for, what they want to pay for a company. And you really get into their heads about valuation and understanding that in a way I don't think you do exactly on the buy side. You're a little more separated from the CEO. But on the sell side, you're his advisor. You're in his head a little bit. And so I understand a little bit about what they don't know and, when they're bluffing and this and that. But the data is in the financials. And I look at incremental numbers, CEO, and then sometimes for small companies, of course, the division heads, they're running things at these small companies. And so I'm looking at incremental data, margin, incremental return, incremental working capital to sales, all these metrics that can kind of get to how's the company running. And I think the best way to do that is just to break down the DuPont formula. So for those of you that don't know about it, just go look up DuPont formula. How are they doing with asset turnover? How are they doing with margin? This leads to return on investment. How's their CapEx? How's their DNA relative to their CapEx? And just break it all down. And what it leads to is a lot of good questions. Now you can start trying to understand how the company really runs. So, but CEOs, I'd say don't trust them, but judge them on the metrics.
All righty. Well, thank you so much for that insight, Kevin. That is going to round out our time for Q&A today. Thank you for the wonderful presentation. It was inspiring, to say the least. I know our audience has definitely enjoyed it at this time. It's been an absolute pleasure having you on today.
Graham, thank you so much. Always a pleasure to be here.
Absolutely. And for those of you out in the audience, if you missed anything, you want to check back on any of the slides, anything like that, there will be a full video recording here on YouTube shortly, as well as on Guru Focus. If you did enjoy today, please take a moment to like and comment your favorite part, subscribe to the channel, and do all the best. For everybody out there, we wish you the best success with your investments moving forward, and that'll be all of our time for today.